Welcome back to part two of our three-part series here. And in this segment, Jered and I are going to dig into the key metrics that drive your multifamily returns. There's going to be things like IRR, equity multiple, DSCR, and cash on cash that we'll dig deeply into. We also are going to look at a side-by-side demonstration of a 5-year hold and a 10-year hold to demonstrate the differences in returns for different hold periods. We're really excited about this one and ready to jump in. Jered, thanks for joining me here for part two, where we're going to dig into the key investment metrics in these type of alternative investments, and then we're going to look at a few hypothetical examples to try to demonstrate our point. Okay. And what I'm going to do first is I'm going to hammer through a few common terms and metrics that are in our specific deals, and then I'm going to have you kind of walk me through what that term actually means and why it's important in the context of SNS's deals, I guess, to demonstrate exactly what it is. So the first one being net operating income, or NOI. Mm-hmm. Can you kind of just walk through that at a high level?
Yeah, net operating income is going to be all of your operating income. So everything for us, for the apartment communities, mm-hmm. all the rent, all the pet fees, everything, all the income that you can make off of the property.
Okay.
Minus all of your operating expenses. So the things that you spend money on to make the property run. So landscaping, fixing things, payroll, right? All of the normal, gas, electric, all that stuff. Any expense that any owner would absorb in running this asset. So you got your operating income minus your operating expenses equals your net operating income. Why this is so important to us as apartment investors is the way you value apartment communities is you take that net operating income and you divide it by the capitalization rate, which is basically a multiplier just as you would value any company. Mm-hmm. So dividing by the capitalization rate, you can think of as the same thing as multiplying it by something, right? We might be multiplying by 10 or multiplying by 20, depending on what that cap rate is. Okay. So the inverse of mathematically is going to be that. So example is like if you have a net operating income of X, you divide it by a cap rate of 6, if that's what the market demands, mm-hmm. then you get your apartment's value. As a value add investor, why this matters so much is the way we force value into the assets that we own is by driving up that net operating income to a higher number. And that can be done in, put simply, 2 ways. Raise the income or cut the expenses, usually both. Yeah. And why I believe SNS has such a positive track record and reputation is because that's what we're really good at, mm-hmm. right? Raise income, cut expenses, drive the NOI, therefore the value goes up, and then we can capture that value in some way.
Okay, well, you touched on the cap rate a little bit. Can you talk about that term as well? I want to understand that a little better and how that's playing into the mm-hmm. value that you're talking about.
Yeah, I think it's a term that gets, frankly, too much attention. Mm-hmm. I think it matters a lot at dispositions and refinances. It matters, especially for value add investors, less on the acquisition. Yeah. Because you have to factor in how much upside the deal has. And so a lot of times we're buying underperforming assets, and the question is how much degree of confidence do you have, or what do we have in the ability to raise that NOI? Mm-hmm. And sometimes if it's a high degree of confidence, we'll pay a little bit for that, and therefore it will drive down the cap rate. But cap rate is just a function of desirability of the market, which sometimes can be hard for new investors to wrap their head around, but it's, if you were to buy this asset all cash, so mm-hmm. no mortgage, no debt, what rate of return would you demand to buy this thing? And you have to imagine if you were buying a D-class property like we talked about earlier, and it's in a really rough neighborhood, and it's going to be a lot of work, and you're going to feel unsafe when you're down there. Yeah. If I asked you the question like, well, what rate of return would you demand, would you require as an investor to buy that without a mortgage? Mm-hmm. I can promise you your number will be higher than if I said, what rate of return will you require to buy that A-plus shiny product with pools and movie theaters and 2 gyms, and because it's going to be easier, it's going to be safer. Yeah. And so cap rate is a function of desirability. So in our market, it might be like that really scary one is you might demand a 10% return on your investment, okay, or a 10% cap rate for that rough property, and you might demand a 5% return on your investment and those are cap rates. And so again, if you take the NOI and you divide it by cap rate, you end up with your value. So dividing by a smaller number will actually increase your value. And so we look for opportunities to push the NOI divided by that cap rate. In our market, we're usually somewhere in that like 6 to 7 capitalization rate for the type of assets that we're buying. Because again, we're not on the A+ shiny, and we're not on the D- really rough neighborhoods. We're settling into the middle.
Okay, so in Cincinnati, the B and the C class are somewhere in that 6 to 7 range, is what you're saying?
Right now, yeah, but
Okay.
it moves.
Moves,
right?
okay.
Because the desirability can move too, because you're contrasting against every other option that money has. You know,
Okay.
we're a capitalist society, fortunately, and so like if apartments aren't good,
Yeah.
and precious metals are really good, or some equities are better, that's where the money's going to go.
Yeah.
And when that happens, the cap rates can slide around, or if people perceive apartments as risky because of some political move or because of some population move, that could push cap rates up, which would devalue the asset.
Okay, well, that's a really good point. So as of fall of 2025, that's what we're referring to for a lot of these metrics.
And that's going to be for stabilized, right?
Yeah.
A stabilized asset. And I kind of hit on it, but I've said this to many times, is like some of the best opportunities we've ever bought were negative cap rates. And what that means is the property was losing money, right? All the income minus all the operating expenses equals your NOI.
Yeah.
And what did you pay for it? And there's been properties that are losing money when we buy them, and therefore have a negative cap rate. And those have been some of our best ones because we know how quickly we can change that income and expenses and change that NOI. So that's why, to me, as a value add investor, the cap rate matters less at acquisition, and more on once you are stabilized and you're trying to value the asset and strip the equity through some debt restructure or potentially a sale.
It's extremely helpful. And I want to transition a little forward now to a term that we talked about briefly in part one. And I know a lot of investors are probably most curious about how much money am I going to get from an investment like this versus what I could do elsewhere. The first one I want to talk about is cash on cash. So what does that term mean to you? What is it? And I guess what type of return are we targeting? And I can circle back to those questions if you need to, but I'll let you roll from here.
Yeah, I think that metric gets probably the most amount of attention because it does answer that question. How much money am I going to get? And I think at the end of the day, that's why people are taking this risk, why people are watching this video, is to learn to be able to invest. But why that metric is so much more important in alternative investments, and specifically what we do, is because we are a cash flow investment. So contrasting it to those mutual funds or bonds and things, it's like you aren't getting that steady cash flow, right? You're putting your money in and you're probably benefiting from value appreciation, but you're not getting anything through the life of the investment. You're just sitting there waiting, holding. And what we're doing is we're producing operational cash flow and distributing that back. So the cash on cash metric, I always think of it as the numerator is the cash that you have into the deal. So if you put $100,000 in, you get $100,000. And then if in 1 year, the first year, it distributes $10,000, 100,000 divided by the denominator, 10,000, you're in at 10%. So it's kind of like, well, I want to know how successful the money I have in is, what is it producing? And that's all it is. And so it answers the question, how much money am I going to get? Right? At the most fundamental level, if you say, okay, in year one, the cash on cash return is 10% in that example, you know exactly how much you're going to get in year one. And then if you average it over a 10-year hold, it's going to answer that same question.
It's extremely helpful. Now I want to move more towards another metric that we like to highlight, and that's the internal rate of return, which is the IRR. Talk to me a little bit about, I guess, how long we hold these deals and that metric itself and how that can change with timing, which we'll dig into more in this video. But what does IRR mean to you? And then I guess explain it in the context of SNS to help me understand.
Internal rate of return to me is factoring in the time value of money. And I think the more sophisticated investors get, the more they realize how important that is, because when you have your money back, you can do something with it, usually reinvest it.
Okay.
And so you tend to get more and more as you grow in your investment career, you tend to care more and more about like, well, how quick can I get my money back?
Yeah.
In addition to how much am I making during the investment? And IRR is discounting all of those future cash flows back to a net present value of 0, which gets kind of into the finance weeds. So I'll just leave it at the fact that if I were to ask you, Steve, like, if you invest $100,000 into a deal and I can, in 1 year, return you $200,000 because the deal was very successful, or over a 10-year span, I can also return $200,000. Which would you prefer? Yep. You're always going to say,
first one.
Give me the first one because I want my money back because it de-risks the deal. I can go do something with that money then and reinvest it and compound and that's what IRR is thinking about. It is putting less emphasis or less value on later cash flows and more value on early cash flows.
Okay.
And so I think that it's very important to factor in the speed at which you get that money back.
Okay. And we'll look at a couple hypothetical holds. So I have a graphic that I'll throw up here in a few minutes, and we'll dig deeper into that to make sure that we can demonstrate what is the difference for like a 5-year hold versus a 10-year hold. But my next question involves the equity multiple, which is another term that I think investors have an easier time of wrapping their head around. Can you just walk through what that means and how that might look for an SNS deal?
Yeah, it's a really simplistic number. So it's just like how of the money that you put in, how much is it going to multiply over the whole life of the investment per the projections. Okay. So if you put in $100,000, you have an equity multiple of 2. Take $100,000, multiply it by 2, you end at $200,000. That means your total distributions will be $200,000, including the $100,000 that you gave us.
Okay.
Right?
So you're doubling your money.
Doubling your money.
Okay. Yeah. Got it. Now I'm going to throw up a graphic here showing a sample $100,000 investment from a previous SNS deal. And this is going to hopefully demonstrate a couple of different things, but the main one that I wanted to highlight was our split, which is something that you touched on briefly in part 1. And then also, here I'm going to let you look at this document and give you the opportunity to explain that, and then also talk about this term Pref that I hear a lot. So I guess first let's talk about the split itself. So you said 70-30 in part 1. Can you just explain that to me a little bit?
Yeah, I will. But first I'll say, just want to emphasize that this sample $100,000 investment distribution is the investment, or it is the distribution to the LP, right? So it's after the split.
Okay. Yeah.
And so our split is 70-30, which means that the limited partners get 70% of the equity. The general partner gets 30% of the equity.
Okay.
But one thing we do to align interests and create a performance hurdle is we put what's called a preferred return to the limited partners in front of the general partners, which all that says is it's a performance hurdle, meaning for us, the first 8% of yield that comes off of the investment will go exclusively to the limited partners. Then anything over 8% is what we call upside. So that upside will then get split 70-30. Okay. So 100% of the first 8% goes to the limited partners, because at the end of the day, like we talked about in part 1, we're contrasting against other investments, maybe less alternative, right? And so what an investor, a limited partner might want to know is well, I want to be sure that the alignment of interest is there, and that SNS, if I'm as an LP making, or I should say if you as an LP are making 4%, and you're sitting there thinking, I could have earned that in the bank, or I definitely could have beat that in the stock market. Yeah. You don't want us to make money because we didn't do our job well. So a preferred return is a performance hurdle. First 8% goes to the LPs. Only after that is met annually, then do we make money on our split. And again, we only make 30% of anything over that 8%. So this chart on the screen here just shows someone that invested in $100,000, and I'm focused on year 1. So you can see in year 0 you got negative. That's your contribution. And then in year 1 you still have in the deal $100,000. The investor return on capital through operational cash flow and distributions was $7,500, which results in a 7.5% return on capital, right? So a cash on cash return. And you might be saying, well, that's not 8%. And that's exactly right. We did not meet the Pref. So that 50 basis point delta that we missed the Pref would accrue, meaning we got to catch that up before SNS or the general partner ever makes money.
So it'll be 8.5 would be what you're saying is owed then?
Yeah, year two's Pref will still be 8, but you're going to carry forward half a percentage point Pref that has to be caught up. So all of that has to be caught up before SNS ever makes money. So it's not like we say, oh, year one didn't go as planned, let's reset the clock. No, we still owe you that.
Yeah.
And until we make that whole, until we cover that, SNS isn't making their split of the money. And so a lot of times in value add, cash flow will be lighter at the front end of the investment because we're buying an asset that has problems.
Yeah.
And so we got to fix those problems. Fixing those problems takes time. But you can see in this investment is once we get in there and we force the value and we restructure the debt, the returns can shoot up. And that's when, if SNS is successful at executing that, that's when we really start making money. So the alignment of interest is favorable because it encourages us, like, well, if you want to make more than 8%, go do your job. That's what the structure says to us.
Yeah. So you're saying that refinance in this case is taking place in year 5 on that chart. And can you walk me through, I know you touched on this already a little bit, but just for the sake of understanding, what is return of capital versus return on capital, especially in this graphic?
Yeah, the second row, investor return on capital, is like the operational cash flow and the distributions from running the apartment community. So, again, all the rents come in, all the expenses go out, the mortgage is paid, what's left over, that's going to be operational cash flow and labeled in this second row, investor return on capital. Investor return of capital for us is defined by proceeds that come from refinances or sale. So I'll simplify it and say, like, Steve, if you were an investor and you gave me $100,000 and you invested in a deal with us and I only ever gave you $100,000 back, you're like, well, you just gave me my money back. That wasn't good, right? And so we split out that when we're giving you your money back that you already gave us, that's a return of your money or return of capital. And for us, that's defined by when we take on more debt and there's proceeds from that debt or from the sale. And so you can see here what this sample investment from this specific offering is. We are intending to refinance the deal in year 5, which will generate proceeds from the new debt because we have forced value and the bank will loan us a percentage of that value. And that will result in proceeds to you as the investor. So of that $100,000 that you put in, you're going to get $61,000 back of that money, but it was already your money. So it's not the money working for you. So we split that out separately. But at the end of the day, then you only have in year 6 and on, you only have $38,000 in the deal. So when you go back to that cash on cash return metric, you think about how much do you have in the deal and how much distributions is it producing. And I'm realizing that I believe I flipped the fraction incorrectly when I defined cash on cash before. So like it should have been the numerator is your distribution and your denominator is the cash you have in the deal.
Yeah, pre-tax cash flow over total cash invested.
Correct. Yeah, when I defined it before, I flipped those. But so 38,000. I'm sorry, 6,000 in year 6, $6,000 total investor distribution over the $38,000 leaves you with that 15.8%. And so, again, we're talking about you go back to IRR and getting money out of the projects. You de-risk it, you get money back to the investor because that $61,000 in this example, this is a very common thing for us to do. You're going to get that back, Steve, and you can go do whatever you want with it. And the other thing that potentially we'll hit on is all of that's tax-free because it's not income, it's debt. And so we'll give that back to you and you can go invest in whatever you want, right?
Explain that to me. Why is it tax-free?
Because we are borrowing that money from the bank. So it's associated with, the reason we got that $61,000 is because it's a portion of loan proceeds and debt is not income. It is debt, you're borrowing it. So you didn't make that money. You borrowed that money, and so it's not taxable, but it's usable, right? So like I think that's a important distinction is like you get the money back.
Yeah, but I can redeploy it then to another deal and just kind of keep the snowball going, is what you're saying.
Yeah, and that compounding effect, and that's why investors care a lot about IRRs because they're like, well, I want to compound, And typical for us is going to be like somewhere around year 3 to 5, somewhere in that range. I would say historically we're between years 2 to 5. We're going to have already successfully forced enough appreciation to where we can strip some of that equity through a debt restructure.
Yeah.
Even if interest rates are going up, we typically are forcing enough value that we can then restructure the debt and then redeploy or do a return of capital to allow investors to redeploy into something else.
Well, that's extremely helpful. I want to jump a little bit ahead now off of the graphic here and talk about a term that I don't think gets mentioned enough. And I know I've heard you say this, it's debt service coverage ratio, which is DSCR. Explain to me that term and then talk about what it looks like in the context of SNS. That would be helpful.
Yeah, no, thanks for bringing that up because I think new investors, specifically the audience we're trying to speak to, they don't think about this at all, but man, do they think about cap rate. And like, I think proportionally it's like, if you're investing in value add real estate, why are we thinking about cap rate at acquisition to the level that we are and not about debt service coverage ratio to the level that we are? And so why it matters to me and why I think it's far under talked about metric is because, well, let me define it. Debt service coverage ratio is your debt service is your mortgage payment, right? So all the debt that you take on, and you're going to annually, you got to pay some amount of money for that, depending on what your structure or an interest rate is. So let's say it's $1 million. So $1 million in debt service per year that you got to pay the mortgage.
Yeah.
The coverage ratio is just going to be a function of like, well, NOI, how much of your NOI is going to the mortgage. And so if you had $1 million NOI and $1 million debt service, then your debt service coverage ratio is 1 because it's a 1-to-1.
So you're dividing your NOI by your debt payments?
Correct, yeah.
Okay.
And why that matters and why, historically what gets investors in trouble and general partners in trouble is when they over leverage or they're not able to service their debt. And that's when the banks come in and they say, wait a minute, like, you're supposed to be paying me. And if you're paying everything, if your debt service coverage ratio is a 1, that means all your money is going to the bank, which means there's none left for the limited partners or the owners. And so I think it's so important because especially if you're focused on cash flowing investments, which a lot of alternative investors are, then you want to know, well, how much cash flow, how thin are we running this, right? And especially if your debt structure...
Wait, by thin you mean getting closer to 1 on that ratio?
1,
okay, but by not thin, you would be higher than that, so
right,
1.2, 1.3 and beyond.
Yeah, I'll take it even further. Like if your NOI is $2 million and your debt service is $1 million, your debt service coverage ratio is a 2.
Okay, 2.
Right. So I would say a 2 or more is a very healthy debt service coverage ratio. Across our whole portfolio currently, we're at like 2.3. So meaning our NOI is very healthy to service our debt, which means we're not at risk of something going wrong, right?
Yeah.
And that's even more important metric if you're going to take on debt that is variable. And I think if you're at all involved in real estate syndications, you will know from 2022 to 2025, a lot of investors, a lot of general partners, fortunately not us, took a lot of variable rate loans and also took loans initially that were squeezed to a debt service coverage ratio of like 1.25 or something like that. And so that means they only have a 25% margin for error. The interest rates move, that 25% goes away very quickly.
Yeah.
And so you want to know what is your margin for safety off of, because the bank gets paid first, right? So like, well, how much is left over and how much bad stuff can we absorb to where we're not upside down or underwater or not being able to pay our mortgage. And rather than go into the variable rate stuff, you could even think of like, well, what if property taxes adjust, or what if my insurance premium just goes up, right? Like that's going to impact your NOI. And if you're really, really close to a 1, it could send you back.
Just like that.
Just like that.
Yeah.
And any amount that you approach 1, it's like all those dollars are coming out of your distributions.
Yeah.
So I think it's extremely under talked about metric and one of the most important ones. And so you should be looking at, as an LP, you should be looking at the specific deal that you're looking into. What is the debt service coverage ratio at year 1, 2, 3, 4, 5? When you're going to refinance, what does it reset it to? Because you're going to take on more debt. So like, how much is this general partner putting at risk? How close to that edge are they willing to walk?
So you take on more debt in a refi, it might go down a little bit, is what you're saying.
The debt service coverage ratio would go down, yes, because oftentimes you're going to take on more debt, which means more debt service, and hopefully you're pushing your NOI at the same time, but it's going to rebalance somewhere.
Yeah.
So I think my opinion, depending on the business model and the plan, is like you certainly don't want to go below like a 1.25, and the lenders usually won't let you. And I think a healthy metric for like a stabilized asset is going to be in like 1.7 to 2, right? Like somewhere in that range would make me feel very, very comfortable that there's plenty of wiggle room, and any bumps in the road can be easily absorbed, and we're not sending 100% of our distributions to the bank.
This is helpful because we're going to build the foundation here in this video for part 3, where we dig pretty deeply into the debt side, which leads me to my next question. Terminology that I hear relating to debt, and we'll just touch on this at a high level and then dig in more on part 3. Loan to value and loan to cost are two that I hear a lot. Can you walk me through those two briefly?
Yeah, loan to value is meaning how much debt do you have on the property relative to what it's worth. So loan is the debt.
Yeah.
To value is like, well, how much is it worth? So we'll take a $10 million property. It's worth $10 million. It's appraised for $10 million. And you have $7 million in debt. Your loan to value is 70%.
Okay.
Loan to cost comes in a little bit more applicable when we're talking about value add strategy.
Yeah.
And so if you are, same example is like if you have a $10 million property and you borrow $7 million from the bank, but you also invest $1 million into it. I'm sorry, if you have a $10 million property and you borrow $7 million, and you invest $1 million, you would add that $1 million to your 10 to take it to 11.
Okay.
And it's going to drive down your percentage to something like 65%, right? Because you only borrowed $7 million on $11 million. And so a lot of times, if you believe there's value to be pushed, and you would hope that if you're investing $1 million into a deal, you're adding more than $1 million in value. Like it would be a bad decision if you invest $1 million and only increase the value of the property $500,000. So I think if you're going to make a heavy investment into improving the property, loan to cost becomes more applicable. Why investors care about this is because you don't want to go underwater. So you don't even want to approach going underwater. So
yeah. So too much leverage. You're saying puts you in that spot.
Yeah. In SNS, typically, like I would say back in the glory days of 3 to 4% interest rates, we were all about debt.
Yeah.
We were taking as much debt as we could get. We were locking it in long term, and that has changed significantly. And now we're more focused on like 60 to 65% loan to cost going into deals, and
right.
We are less favorable on debt, and we still want it safely structured, but it's just too expensive.
Well, that's a really great illustration there. I'm going to jump ahead now to another graphic that I'm going to show, which I talked about earlier. It's a hypothetical 5-year investment versus a hypothetical 10-year investment. And these aren't actual returns from any deals. They're kind of just a way to demonstrate exactly kind of how that IRR would work in a shorter hold versus a longer term hold. And you got your equity multiple coming into play here, loan to value, cash on cash, kind of giving you a holistic view at how this might look differently for different business models. But I'll let you take a look at this, and I want you to walk me through a couple of different things. But can you talk to me a little bit first about how the cash flow profile is going to differ possibly on a 5-year hold versus a 10-year hold, if at all, for SNS?
So SNS typically doesn't do 5-year holds. So I would say if I'm understanding these charts, like the 10-year hold, it would be more like comparable to what you'll see from SNS, and a 5-year hold would actually be more comparable from what you'll see from the industry standard.
Okay.
So we are significantly longer than the industry standard. So maybe in these charts you could see it as contrasting industry standard to SNS.
Yeah.
And you'll see that the IRR is higher on the industry standard than the longer term, because again, IRR is about when did I get my money? And if you're doing long-term holds, those cash flows are further out into the future. The 5-year hold is about selling the property in year 5 and getting a big windfall from the proceeds of the sale around year 5. Now, in this hypothetical example, I'm going to assume that this 10-year hold doesn't have a refinance somewhere in there. And that's the way we really maximize IRR, is by stripping the equity out of the deal somewhere in that kind of year 2 to 5 time frame. So that way we're getting similar benefits to the 5-year hold, but we're not having to sell the property, realize the tax hit of selling the property. And what I hope I can emphasize here is the burden of redeploying the capital. So you got tax burden. I think a lot of people would understand when you sell the property, you got to pay taxes on it.
Yeah, and you said that refinance event is tax-free.
Correct.
Too.
Yeah. Yeah, I would say tax deferred is the right way to.
Tax deferred.
Yeah, so like one day it will come, but not yet if you're refinancing.
Yeah.
And what I think is really important to say is like IRR really is important, and as you increase in investment sophistication, you care more and more about it because you want churn of capital, you want compounding. But a lot of our investors are not hedge fund managers, right? So there's a component to IRR that doesn't get talked about enough, which is like the headache factor, right? I shouldn't say it's a privilege to have so much money. You got to figure out what to do with it. But when you churn capital, you got to imagine like if you sell the property and you send it back, the first question that every investor has is like, well, what am I going to reinvest it into? And that thought process is an expense, right? Like, and if you are just on autopilot producing cash flow from a deal that you already know, you don't have to go through that reinvention, and you don't have to assume risk in the unknown. Rather, you stay in what you do know. And there's something to that. It's very hard to quantify. But if you're just looking on a spreadsheet and financial metrics, and you're talking about IRR, like you want to churn, right? You want money in and out of deals. But putting money in and out of deals, if you're not a full-time fund manager, is a full-time job, right? And a lot of investors don't want to do that. What they want is they want to put money into a deal. They want to de-risk that money, and they want consistent, predictable cash flow. And that's what I want. And that's why I built SNS the way we did. Is like I want to understand these properties really well so we can polish them.
Yeah.
Because every time we buy a new one, it is taking on some level of risk of the unknown. So I hope I explained that well. But to me, in this example, you kind of have roughly a 300 basis point change in your IRR. And it's like, well, is that worth it? Is that worth it to reinvent it and take on the new risk? Maybe to some people, but maybe not to others. And then contrasting to the equity multiple, in the 10-year hold, you're going to make more, but you got to wait another 5 years to make it. Right?
So that value will keep increasing, but you're right. I mean, it's 5 years down the road. Do you want to wait that long? So I think at the end of the day, it sounds like you're just weighing a lot of different variables, deciding what's best for you, what's your time horizon, and what's your risk appetite.
Yeah. And I mean, leave multifamily syndications and you go into single family flips, right? Your IRRs can be extremely strong. And you can churn capital in 3 to 6 months. But it's a ton of work, and you got to reinvent it every single time. And it's like, if that's what you want, invest in that. But that's certainly not what we are.
Yeah. Well, that's helpful. I don't have any other questions on this chart. And as far as part 2 goes, I'm very happy with where we're sitting right now before we transition to part 3. And we'll talk more in the next one about debt, financing structures, and dig a little bit more into the sponsor fees and conclude our series here. So thank you.
Great.
Well, that wraps part 2. By now, you should have a clearer understanding of how to evaluate the numbers and see how investment timelines affect overall performance. In part 3, we're going to tie it all together by exploring debt structures, sponsor fees, and how SNS approaches alignment with our investors.